Class is now starting. All attendees are in listen-only mode.
Hi everyone, I'm Ben and welcome to the Signal Center webinar today. The Signal Center is a free trading tool with Equiti, which is available in your client portal and also through your MT4 and MT5 installer. Today, Joe Neighbour from Signal Center is going to take you through the best ways to utilize the tool. Now, to access the tool, you need a live account with Equiti, available at equiti.com. And then to find the tool, you just need to navigate to the Analysis tab within the client portal. Now, there'll be some time for questions afterwards. Otherwise, please enjoy the webinar, and Joe, take it away.
Thanks very much, Ben. Lovely to be here, everybody. Hopefully, everybody can see my screen. I've got a slide in front of you there, and going to go through various ways of how to spot trading opportunities using the Signal Center tool, give you some more information and background about Signal Center, and also a few trading tips as well, which can help you along your trading journey. If anybody does have any questions, please feel free to put them in the chat of the webinar, and we will do our best to address those. And yeah, please sit back and enjoy. So first of all, going to get into the agenda today. As we mentioned, we're going to talk about an introduction to Signal Center, who we are, what we stand for, and what it is that we hope that we can help clients and traders achieve. Going to go through various ways of trying to successfully interpret the signals and making sure that when you do access the Signal tool, that you know exactly what it is that you're looking for and how to best use those signals that we provide. Then we're going to talk about a couple of things around managing expectations when it comes to signals and generally about financial markets, because as we know, they're all quite challenging at times, and also a few ways on how to improve your general approach to risk management. So hopefully a few nuggets in here that will help you, as I say, along the way. So firstly, about Signal Center. Now, we first came around in 2009, just shortly after the financial crisis, or around the time of the financial crisis, and we were made up of a group of technical analysts who were providing investment strategy and research to hedge funds and investment banks. So primarily we were providing directly to institutions, but as the business has evolved over time, we've moved more into the online broker space and working with companies like Equiti to provide services of an institutional level to the end trader. Now, the idea behind our service is to provide very clear, actionable trade ideas that can be used by any market participant, whether you are a beginner or whether you're an advanced user in financial markets. It's pretty simple to understand, and hopefully now you'll see that from when we go through the tools in a moment. And the business has grown very well over the number of years, and we're working with some of the the biggest people in the industry and evolving the ways that we come up with trading analysis to try and find every kind of edge that we can to help give traders every advantage. Now, our approach is primarily based on technical analysis. So we have a team of expert analysts who are situated around the globe. So that means we can cover all asset classes across all time frames. And we deliver this analysis in a way that is easily actionable, but also gives users plenty of time to take action as well. It's no good firing out a signal that you have to react upon straight away as soon as it hits your phone or your desktop. We want to give everybody equal advantage of being able to take advantage of these moves in the market and being patient in doing so. So as I say, we can adopt our approach, or our approach is suitable for any type of trader, whether you're a beginner or whether you would consider yourself an expert. So how to successfully interpret the signals. Now, the image I've got in front of you here is our signal stream tool, which is what Ben alluded to, you have access to on the various platforms via Equiti. I'm going to go into details about how to use this, and then we'll move on to the other areas of the webinar, talking about expectations and risk management. So what I'm going to do now is just switch the screen that I'm sharing and take that over to the MT5 platform that I have on the screen now. Now, once you access the Signal Center Trade Ideas Expert, which you'll see down here on the left-hand side, you apply this to a chart and it will bring up this disclaimer. Obviously, disclaimer is very important. Obviously, there's risks involved in financial markets, as we all know, so please familiarize yourself with those. Once you've accepted the disclaimer, then you'll be taken through to the tool, and this is how it will look. So hopefully it all looks quite engaging, quite visually appealing, and from here then we can start to find trading opportunities to potentially take advantage of. So I'm going to go through each of the aspects here, explain as much as I can. Hopefully I won't leave any stones unturned, but if there's anything that I've not made clear, please do bring that up in the Q&A, and of course we can address that. So right here on the screen, we have the stream. Each of these tiles represents live trading opportunities today. So anything in red, quite simply, is a sell opportunity. Anything in green is a buy opportunity. Now, we use a variety of limit orders or stop orders to get into the market. So all of these ideas are pending ideas when they appear on the signal stream. So they are not ideas that you need to take immediate action on. There will be specific levels that we're looking to take action on each of these markets. The terminology that we use, buy limit, sell limit, buy stop, and sell stop, it's the same terminology that you will see used on the MT5 and MT4 deal ticket. So if I was to open up a new order ticket here, you will see that we can have different types of orders, but if we were to do a pending order, then we would have a buy limit, or we can drop down to sell limits, buy stops, and sell stops. So hopefully all fairly self-explanatory. So each of these tiles, if we just go through this opportunity here, this is New Zealand dollar, Japanese yen. We can see that it's a sell limit. By the red on the tile, we can see that it's also got a bearish bias to it today. We've got the confidence score here, which today is at 40%. I'll go through more information on the confidence score very shortly. And then we have the key actionables that you need to pay attention to on this particular idea. So we have the entry, which of course is all important. And today we're looking to get into New Zealand dollar, Japanese yen at 83.50. We've got our stop, which again, very important, and that's at 84.30. And then we have a target, which is at 81.52. Now, there's various ways of filtering this to try and find the higher quality opportunities. I mean, we believe all the ideas that we produce are higher quality, of course, but if you maybe wanted to focus on higher confidence scores, then we've got this toggle up here, which will allow you to scroll through the different opportunities that are present on the day. So the way that we do things, we will produce signals on around 40 different markets per day across FX, commodities, indices, and cryptocurrencies. We'll also produce a number of ideas on single stocks as well. So you will see those filtering in to the signal stream from time to time. In terms of the time frames, all of the ideas that I mentioned on FX, commodities, indices, and cryptocurrencies are intraday trade ideas. So we are looking to get into these ideas today, and they will expire after a certain period. And I'll come on to the relevant expiries very shortly. There's also other methods of filtering. So we can filter by asset class, as you can see up here in the class section. You've got the drop down, which will allow you to filter for FX, commodities, indices, cryptos, and stocks. And we can also filter by status. So you can look for ideas that are live at the moment, or if you're only looking to buy ideas on dips or sell on rallies, then there's various ways that you can filter that. And we also have a variety of different languages that are available as well. And just by clicking on those, you can change that very quickly. So let's focus on this New Zealand dollar, Japanese yen idea. By clicking on the idea, what you're going to get is a lot more information about the specific trade idea. So there's an educational element to these trade ideas. We're trying to promote and show what it is that the analyst is seeing on a daily basis or on the charts at present that has made him or her come up with this specific trade idea today. So as we can see on the top left, we've got the asset, New Zealand dollar, Japanese yen. We've got the price, 82.33. This radial gauge that we have here represents short-term news sentiment. So we work with a company called Equiti Trading. Equity clients will also have access to these tools as well. And maybe we can do an alternative webinar on that at another time. But ultimately, they use artificial intelligence to scan millions of articles on a daily basis. And we use what's called natural language processing to identify in those articles where certain assets are being mentioned. And from those articles, we can then actually come up with a score based on those articles as to whether or not the underlying sentiment is bullish or bearish towards a particular asset. So it's really clever, cool technology that we are trying to use alongside technical analysis to really try and give us every opportunity of beating the market. So at the moment, we can see here that the news sentiment towards New Zealand dollar, Japanese yen is considered to be 100% bullish. Now, obviously, we've got a sell recommendation on this today, so there will be times where the two don't marry up, and that will be reflected in the confidence score. So as we can see, previously we had a 40% confidence score, or on the bar over here, 2 out of 5 bars have been filled. So when everything lines up, where we've got trend in our favor, where we've got new sentiment in our favor, and when we know that the analyst form is going well as well, then we bring all those confidence factors together, confidence score. So coming back to the idea itself, as we can see here, it's a sell limit. This is the level that we are looking to get into the market at 83.50. So at the moment, it's a little bit away from the current level in the market. We are patient in our approach, so we wait for the market to come to us rather than chasing it or executing levels or executing trades at any level in the market. You need to be patient in order to be successful in financial markets. So here we have 2 targets that we're looking for on the downside in this instance, because this is a sell opportunity. We're looking to sell into a rally in the market. And on the downside, we believe it's achievable to hit 81.52, which is where we've highlighted a level of support. And below that, we've got an additional level to target, which is a nice round number of 81. And on the right of that, we have the stop loss, which is at 84.30. So down here, we have the description of the analysis. We've got some timestamps here. So you'll always be aware of when the idea was published, at what time it was published, and you'll also be informed of when the trade idea expires. So in this instance, it will expire at 9 p.m. UK time, or 6 p.m. UTC +3, and that is when the idea will no longer be valid, and we will replace this idea with a new trading strategy. So there'll always be something to focus on and to look at, but we are constantly refreshing these ideas with the changes in the market. From this, the next stage is the sort of explanation of the idea itself. So here we're going into some detail as to what it is the analyst has seen on the chart. And he's describing this using technical sentences here to explain what he sees on the chart. So we can see here sentiment remains negative despite the pullback higher in price. We can see the pullback here on the chart over the last few hours. We've got some bespoke resistance at 83.50. If I hover over the 83.50 here, I can see that this is the entry that we're looking at. And for those that are keen technicians and looking at charts on a regular basis, you'll be able to see that that marries up with these sequence of lows along here. So we can see and visualize that there is some resistance there on the chart. And we can also do that same with the stop. So there's a gap on the chart there, but we've got our stop loss just above that. And we're looking to target a move back down to new swing lows. Now, we have also volatility events, so it's important to be aware of key macroeconomic events that are due out throughout the trading session because they can create volatility. Obviously, the more aware you are of these, the better you can manage your trades or maybe avoid trades if something's too high impact and likely to create too much volatility for your particular style or approach or general emotional well-being when you're involved in markets, then you may want to be aware of these. So we do our best to make sure that we highlight relevant events to these particular markets. Next up, we have resistance and support levels, fairly self-explanatory for those that have been around markets for a long period of time. For those that are beginners, support and resistance levels are deemed to be areas where we believe markets prices can either stop and reverse in either direction. So a resistance level is above market price, a support level is below market price. We've identified these levels which aren't shown on the charts, but for more advanced users who maybe have their own strategy or their own approach and maybe want some validation of their own trade ideas, they may want to consult these support and resistance levels to see if they match up with their own opinions on markets, and if they get our analysis matching up with their own thoughts and ideas, it may give them that additional confidence then to go on and place a trade. On the left-hand side, we have the chart. Now, these charts are all 4-hour charts. So each candle represents 4 hours worth of price action. And we also have this visual here in green and red, which I'm sure most of you have spotted. Now, this is a way of visually showing the risk reward of the opportunities that we are posting. Risk reward is simply how much are you risking versus how much are you looking to make as a reward. And as a bare minimum, every trade idea that Signal Center publishes will have a risk reward ratio of 2 to 1. So for every $1 that we risk on a trading opportunity, we will always be looking to make at least 2 in the reward side of the trade offering. So it's really important to bear that in mind. And we'll come on to this again in the risk management part of the webinar. But yeah, that's a nice visual here. You can see the green area is much larger than the red. And if you want to be successful in financial markets, making sure that your risk reward ratios are beneficial and give you opportunities to make much larger returns than the amount that you're risking on trades, then you're going to have a much better chance of success. So that kind of explains really everything we have to offer on the Signal stream. Obviously, there's many other ideas on here that you can go through in your own time. We've got a couple of live ideas at the moment. So we've been triggered on US dollar CAD today. So we're looking to buy this. The confidence is a little bit higher than what it was on the New Zealand dollar Japanese yen idea. We can also see that the new sentiment is in line, and those looking at the chart can see that there's a nice upward moving trend here, which again is beneficial if you're looking to buy. We can also see here there's been an update. So as soon as the ideas are triggered, we will update you to let you know that the market idea has gone live. And then obviously you can start your monitoring process on your trading platforms. Now, those will also have noticed we've got a trade now button here, which I haven't touched upon just yet. But this is a really cool function just to try and make it very easy for users to look at our opportunities. And if you want to go ahead and replicate those ideas, we've made this process very simple. So if you click on that trade now button, what it will do is bring up a deal ticket, as we can see here. So there are different ways we can do that. So we can do market orders, pending orders, but really what we want to focus on is the pending order, because these ideas are created in order to be followed using pending orders rather than at market. We've populated the volume with the minimum amount. It's not for us to decide how much you should be risking. That should be down to you and your own approach to risk. We've got the order type in here, which, as we know, is a buy limit. And we've also got the relevant price levels here as well. So we've got the current price, sorry, the price at which we wish to execute, the stop loss price and the take profit price, and also the expiration. So when this idea ceases to be an idea and when it expires and we then go on to write new analysis, this idea will actually fall off of your order pad, and we will then have to have another look at a new trade idea the next day. It's no good us posting up an idea, that idea becoming expired, but then you getting triggered on that afterwards, and then we've got no way of helping you out because we're no longer monitoring the trade. So by clicking the place the order button, very quickly you can see the order has been placed, and you will find it in your trade tab here on MT5, and then obviously we can start watching that and see if it gets close to triggering. In this instance, obviously we've already been triggered on this one, so it wouldn't be an ideal one to add. But hopefully that kind of makes it clear as to how to use that particular tool. So that is the MT5 tool, and this video will be available on YouTube afterwards. If there's, if you want to refresh your memory on this and what I've gone through, then obviously go back and check out the video. There's also user guides which we'll be publishing on the Equiti website as well, to give you, an in-depth idea of each of these data points that that we've just gone through. So I'm going to stop that now and move on to the PowerPoint again and start running through some different aspects to try and boost your trading and help you on your trading journey. And I'm going to start off looking at risk management and go back to that idea of risk reward ratios when trading. So when we publish our performance, or when we talk about how successful trades have been, we always refer to our returns as R, and what that means is essentially risk. R is the amount of money that we risk on each trade. So as I said, if we've got a trade idea that we've published with a risk reward ratio of 2 to 1, R is 1, so we're risking 1 and trying to make 2R effectively, and that's how we try and measure it. So it's effectively the distance between the entry point of your trade and the stop loss order. So we have a chart here that demonstrates that we're looking to sell euro yen in this instance into this resistance line, and we've got the visual of the risk reward here. The stop loss in this instance is 35 ticks and the target is 90 ticks, so we're looking for 2.57 R on this. So that's how much we're looking to make compared to how much we are risking on this trade. Hopefully that makes sense. Now this is an example of this in practice, and why it's really important, we believe, to adopt this kind of risk management approach. So this is talking about the NASDAQ. This was done some time ago when the NASDAQ was at 7,350. So the example that we've got on the screen here is that we placed an idea to buy the NASDAQ at 7,350 with a stop loss at 7,300 and a target at 7,500. So 50 points is the difference between our stop and our entry level. Now, if we were to talk hypothetically about how much we were risking on this particular trade, because that's a key question that we always want answered, how much are we risking on each trade? So if we say in this instance we're going to risk £100 or $100, then what you would do is divide the monetary value by the stop amount. This is particularly relevant for indices. It's slightly different with lot sizes on foreign exchange, but there's lots of calculators available out there that will help you calculate this effectively. So the trade size here in this instance is 100 divided by 50 equals 2. So we're going to do $2 a point, or 2 lots on the NASDAQ. So therefore, if our trade hits the stop, we will lose 50 points, and we know that that's 50 times 2. So we're going to be losing our £100, or 1R. We'll be down 1R. If the trade hits the target, we'll make 150 points, and at £2 a point, or 2 lots a point, 2 lots, that will be £300, or 3R. So we've risked £100 to make £300. And this is just how the sort of ebb and flow of performance went on this particular market, I believe during 2019. So 1 year performance from NASDAQ, we posted 80 trades over the course of the year. We had a positive win rate of over 50%, which isn't always the case, but having that risk reward of in excess of 2 to 1 means you can maintain profitability even with win rates at around 30 to 35%. We had 31 losses, 5 of the trades were flat, and on average we made 0.19 R per trade. So if we were risking £100 per trade, effectively we made £19.80 per trade, which if you times that by 80 trades is not a bad return at all. And we can see here the monthly breakdown. So obviously there's a few months where not a lot was happening, and that may just be down to current conditions in the market. Obviously when markets aren't trending, it tends to be quite difficult to make too many outsized gains on a particular market. But when they go through phases of volatility, or they're trending particularly well in a direction, then that's when we tend to find that the signals work best. And in this instance, we can see we had some outsized gains during April and October, and they more than made up for the periods of underperformance that we had throughout the trading year. So hopefully, again, that makes sense. So when it comes to risk management, and I mention it again, how much do you risk on a trade? Now, this is obviously very personal to everybody, but it's very key that you don't trade too much, of course, because you don't want to blow your account up by trading too large on 1 or 2 trades. But at the same time, you don't want to trade too small that it isn't worth your while, or it doesn't keep you interested. So it's very important. Emotional well-being is very important in financial trading. There's no good you putting a trade on and you checking your phone on your MT4 or 5 app, every 10 seconds to see how your position's performing. It should be comfortable enough that you've accepted the amount of risk that you're taking on a particular trade, and then you can sit there and let it play out as it should in line with the strategy that you're following, whether that be signals from Signal Center, your own ideas, or from any other source that's available out there. Things to consider when you are doing trades or placing trades and how much you're risking on a per trade basis is what is your win rate on trades, because there will be periods where markets don't go the way you think they're going to go. There's going to be events that are going to occur in the market that are going to take you by surprise, and losing streaks are inevitable, unfortunately. So it's important that when you're analyzing how much you should be risking on each trade or setting those parameters in place, you should be aware of sort of historical trading that you've done and be aware of what your average win rate is to ensure that you can survive those inevitable losing streaks. Now, in terms of managing expectations, again, coming back to the amount that you're risking on a trade basis, the way that we do it here in order to normalize effectively performance that we have on the trades that we publish is that we base each trade recommendation on a risk factor of 1% of our trading capital. So let's say we had a hypothetical $1,000 or $1,000 in an account. How we would do this is risk 1% of that trading capital on a per trade basis. Now, that may not sound very exciting to many people, that you're only risking $10 a trade, but we're hoping to be in the financial markets for the next 20, 30 years, rather than just focusing on what we're going to do by the end of the month. So it's really important to not let convictions determine your trade size. And what I mean by that is you've really got to stay consistent with your approach. So that's why we do this 1% method, or you could choose a fixed amount of capital on a per trade basis. And you've just got to trust your systems, because by having that approach and having that consistency, you can start to look at your history and analyze your history, and then start to work out where the errors are occurring and how you can potentially iron out these issues by having a more consistent approach. I did a poll a long time ago now, but asking people how much they risked on a per trade basis. You can see the results here. I mean, it's not a huge sample size. We've only got 62 people answering, but these were people that were live in the market and trading on a daily basis. And the smallest percentage was actually 0.5 to 1%, which is, if you look at the professionals in the financial market who are trading for a living, you will find that most of them are risking in between these amounts, 0.5 to 1%, if they're trading on a consistent basis. Obviously, you'll have people that are, they'll swing it around, big star with lots of cash, and they've got deep pockets to be able to run out positions over a long period of time. But for those who are trading with limited capital, it really is important to be consistent. If you were following our trade ideas and risking anything between 2 to 5%, and you were to trade every single trade idea that we publish, at the higher end of that, let's say 5%, where most of the consensus fell, you would actually not be able to sustain the drawdowns that happen on the signals, and there will be so much emotional stress that you would go through along the way, that the chances are you'd probably end up quitting or giving up trading altogether. So it really is important to be consistent. And the thing is, with expectation, who knows what one trade is going to go on and make you the big bucks. It may only be a handful of trades a year that go on to hit 5 or 10 times the amount you risked on a per trade basis. Most of them are probably going to fall by the wayside, or going to be very small winners or small losers. So there's generally no reason to have any sort of outsized conviction on any one trade at any one time. So I've got a few tips here on how to grow a small account. One of the main things, again, is coming back to this idea of trading based on a percentage amount of your account. So if you've got that $1,000 in your account and you're risking 1% of that trading capital on a per trade basis, if you go on a winning streak and your account starts to increase in size, then obviously your trade size is going to increase as well. So you're going to get that compounding effect along the way. And that's all going to contribute to your bottom line. It's going to help you grow that account a lot quicker by doing it that way. The other way, as simple as it sounds, is to make regular contributions to your account. So if you started off maybe with £1,000 worth of capital in your trading account, then why not just throw in another $20, $50 a month if you can afford it? That may mean just, you know, one less or two less trips to the pub a month, or a couple of less coffees. All of this is going to continue to build your capital, and of course going to grow the potential trade sizes that you've got on your trading account as well. And the most important thing, I think, is to think long term. You know, anybody that's trading financial markets comes to the market with this opinion that they're going to make millions of pounds by being a trader. The reality, sadly, is a lot different, and you know, it is really difficult to make money in financial markets. But if you take a step back and actually try and think longer term, rather than trying to make quick bucks, you know, in the space of a couple of months, then you can really start to work on a longer term plan that's going to you know, work alongside your day-to-day living expenses, and, you know, jobs that you've got on the side potentially, you know, and help boost your overall earnings. So this is one of the things that I like to bring up quite often, actually, when doing these, and it is, again, this idea of thinking long term. So this is just a simple compound calculator website, and if we go on here and type in our initial balance, I've started off with $100 here, as you can see. So if we put in $100 as our initial balance, and if we can try and achieve 2% a month on your account, so effectively, you know, one or two winning trades, if you can get 2% a month, I mean, you're doing pretty well as it is. But if you can manage that on a consistent basis, or maybe one month you'll earn 4% and next month you'll earn nothing, or, you know, anything around that kind of number. But if you can compound those returns on a monthly basis, and you can make some small contributions along the way, $20 in this instance, and you can do that over 20 years, you could potentially grow that $100 account to be worth $126,000. And that is the power of compounding and having a long-term approach to financial markets. So obviously we can add another naught to that balance, and then obviously the numbers start to become very much more appealing. But, you know, the key is you've got to be able to stay in the game, have a good risk management strategy, and think long term and have a consistent approach. So that kind of concludes, I think, where I wanted to go with this. Hopefully that was useful for people that have been watching. I don't know if there's any questions, Ben, that we can go through.
Yeah, hi Joe. Thanks a lot for that. Really great, lots
No
of
worries.
detail there. And we have had a couple of questions come through, so we'll just run on those. The first one was, where can they get the signals from? So I'll take that one quickly, just on the way to access via Equiti. You'll have to have an Equiti Live account, as I mentioned earlier, and you can get that from the equiti.com. That's equiti.com. Sign up for the live account. You'll immediately have the signals available, and the signals are available in the client portal, and also there you'll be able to download the MT4 and MT5 installer. Next question was regarding the installer. So Joe, maybe you can take that, but it's just, how can they see the installer once it's downloaded? So what would they do in their MT4 for that?
Okay, let's bring up the MT4 again. Let me just share my screen. Okay, so we're back on the screen, and you'll be provided a link from the Equiti platform. And once you click that installation link, you will be presented with an installer, which will look like this. It will have the Equiti logo. Actually, I'm not sure you can see that, so let me just show you how that looks. Can you see that?
Yeah, can see that. Yeah.
Yes. Going to be presented. Once you double click on that, it will ask you to install. It's just a couple of clicks of the button. It won't let me do it because I've already got it installed, but it literally is as simple as that. And then you apply it for a trading platform, and then you will see it appear here in the expert advisors. Now, once you find it there, you simply just need to drag it across to a chart. You'll need to allow DLL imports and allow algo trading, and you'll also need to make sure that algo trading is clicked up here. Then you'll press OK, and you should be presented with the disclaimer screen again, as we are there, and then you'll have access to all the latest signals.
That's it. Brilliant. We have had another question just saying that the access was denied. So just ensure that you are accessing via a live server through Equiti and not through the demo, because you probably won't have the access via your demo. So make sure you're on the live and obviously get in touch if there are any problems after that. Thanks a lot again, Joe, for your time. Really appreciate it. And
No worries.
I
There
hope
is
it's been
one more
useful.
thing I can go through, Ben, actually.
Yep.
Just because, you know, it's the question that everybody wants to know, and rightly so, is how good are the signals and what can they expect in terms of performance wise. So
Perfect.
I think it's important not only for managing expectations, but also to highlight another point which I mentioned earlier on. So this is our database of trade ideas. We've gone back to 2017 here, so we can get a good idea of you know, how things look over the longer term. So we have got a fairly rich and comprehensive amount of data here about our trade ideas. Now this is, as I say, going back to 2017, we're working on a hypothetical account balance of £1,000 and we're risking 1% of trading capital on a per trade basis. So since 2017, we've published nearly 14,000 trades, and believe it or not, the average win rate is actually below 45%. Now, you know, obviously that's generally not something to shout about, because, you know, people will be concerned, well, why would I follow those ideas if the win rate is so low? Well, the reason that it's maintained such profitability and success over that time period comes back to that idea about risk reward. So every time we place a trade idea, we're always looking to make 2 times the amount that we risk on a per trade basis. Sometimes we'll make, you know, 3, 4, 5, 6, 7 times the amount that we risk. And it's those big gains over the course of the year that really add up and put that profit and loss on an upward curve. So we've got lots of data here. As you can see, this is the chart. This is also highlighting the difference between a fixed approach to risk versus a compounded rate of risk as well. So this light blue line here is based on risking £10 per trade. So we've maintained the same rate of risk on every single trade for this particular version, which is £10 per trade. So even as the account has gone up in value, the trade idea has remained the same. But by taking an alternative approach here, the darker blue line, by risking 1% of capital per trade, as things really start to lift off and we go on a winning run, the size of the trade starts to increase as well, and we can actually benefit from the effects of compounding along the way. So it's not a straight line by any means. There are periods where we have unbelievable winning runs, but then there's periods where, you know, things don't work out so well. Obviously on a per instrument basis, there are instruments that consistently we do very well on, and there are others that we don't. That's just the way it goes. And obviously there'll be periods where, you know, form changes or, you know, particular months really where things aren't particularly good. So again, just coming back to the idea of managing expectations. The final thing I wanted to show is about how much you risk on a per trade basis. So in here, we've got 1% risk. If I was to change this to 0.5, we can actually see that the performance actually improves throughout that period, because we're not getting the big drawdowns. We're, you know, managing our capital in a really prudent way. It might not be exciting. It might not be why you've signed up to get involved in financial markets, but if you still want to be here in 15, 20, 30 years, then these are the time I really think more long term. Now, if I were to change this to say 3% of capital, and I think if you analyze your own trading and actually ask yourself the question, how much am I actually risking of my capital? How much percentage am I risking of my capital on a per trade basis? Then you know, you may be in for a bit of a shock here when I click 3%, because you would have actually blown up your account and not been able to withstand the drawdowns during that period. So that's a pretty scary sort of way of looking at it. And I don't mean to scare anyone off, but I want you to be successful, and I want you to be, you know, still trading in years to come. So it really is important to focus on these things. You know, they're minute details, but they really are going to help you on your journey to becoming profitable.
Excellent. Thanks for that further insight. Really, really interesting, actually. And yeah, I think managing expectations is something that we always do here at Equiti. These signals are not guaranteed wins by any means, but they are, you know, from your professional team, and hopefully they're going to help some of our traders along.
Yeah, we hope we can give traders, you know, enough early success to get them interested, get them on that path, show them, you know, that there's various different methods and, you know, what the requirements are to be successful over the long term.
Exactly. Well, I just want to say thanks again for your time. It's been really helpful. I'm sure it's going to help a lot of our clients get onto the signals and then also utilize them to the best ability. So yeah, thanks a lot, Joe.
No worries. Thanks, guys, and enjoy the rest of your evening.
Take care.